Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Chris Seveney. Chris has developed over $750 million in real estate and built a note investing portfolio valued over $12 million. So thank you so much for being on the show, Chris.
Thanks, Charles, for having me. How are you today?
I'm doing well. I'm doing great. It's awesome that we were able to connect.
Oh, yes. No, absolutely. And again, thanks for having me on.
So tell us a little bit about your background, both personally and professionally, prior to getting involved in real estate development, investing, and note investing.
Yeah. So my background kind of started in real estate. In reality, I went to college for civil engineering back in the mid 90s. And when I got out of college, I started working for a large commercial general contractor in the Boston area. So that's kind of was my introduction to real estate. I always loved real estate and it was a passion of mine. And after I graduated college, I worked for them for about 15 years up in Boston, then 10 years, and then moved down to Washington, D.C. And after that, got burnt out, working many long days and weekends. I flipped as in the construction world to what they call the dark side. And the dark side was going to work for a developer. So I made that switch over to a developer. And once I made that switch, the people I were working for were much more entrepreneurial. And a lot of them had, rentals and other properties. And this was right around the time of 2012, 13, where the market was slowly starting to, turn around. So my wife and I, we built our primary residence. And then after that, we had a good amount of equity. So we started buying some rentals. The challenge we had with that was two kids, my wife and I both working full-time jobs. So we couldn't really scale that. And also Washington, D.C. area is extremely expensive. Mm-hmm. So what we ended up doing was not, after a few rentals, basically just stopping, not having any more rentals. And then what we did, I came across note investing, which honestly I'd never heard of at the time. So most people who were listening may not even have heard of note investing. So I wanted to kind of bring that to light to people because it's a very niche industry and niche market that most people aren't even aware of. And that's kind of, I started 5 years ago, got the ball rolling, and we can talk a little bit more about that as we move on this episode.
Okay, awesome. So explain a little bit about note investing. What types of properties are you financing? Are you generating the notes or purchasing them on a secondary market?
Yeah, so we purchase them on the secondary market. We typically don't generate or create the note in most instances. And there's a lot of people out there who do that, private money lending, where they'll do it for, typically you'll see that on fix and flip deals or other type of deals, because you don't do it on primary residences because of all the government regulations that are involved. Now, on the flip side, we're on the secondary market where we are buying a lot of those single family residential first position notes is where we invest. So we have to really put together a strong team in place to make sure we stay in compliance with all the state and federal regulations.
Okay, so these properties these properties, they might actually have someone that is the homeowner that they're not just a flip property. Is that correct?
Yeah, I would say 95% of them are single family owner occupied, or, the other 5% is most likely people use it as a rental property.
Okay, awesome. Yeah, because for the returns, when I was reviewing your website, and we can go over the returns here, but the returns are very high. And that was something that if you want to explain how you're getting these high returns and what the returns you can expect.
Yeah. So when you're buying, most people are like, well, why are you buying notes? And typically what we're doing is we're buying non-performing notes, meaning borrowers who are not paying. So that lends the question of why would you buy a note when somebody's not paying on it? It's the same thing of why you buy a house that needs lots of repairs. You buy it at a substantial discount. We try and buy loans typically on average between 30 and 60 cents on the dollar when they're not performing. And that's completely dependent on the state it's in, the property condition, the property value, how long it's been delinquent. And most people, I just want to mention this too, when you think like I have a mortgage, and a lot of people who are listening probably do. You think you miss one payment, like somebody's going to come knocking down your door and tearing you out of the property. Most of these borrowers are borrowers who have not paid, not months, but years.
Yeah.
So, and the big institutions and hedge funds don't do a lot with them because a lot of times it might be a $40,000 asset that for them, they're managing $400,000 assets because the costs are the same. Costs the same to foreclose. Doesn't matter what the loan value is. So a lot of times these just get pushed away and they look to sell them, which is what allows them to be bought at a discount.
So what is the business plan with it? You're obviously buying these at a discount, which is fantastic. There's value there then because you're buying them distressed, and you're buying them from people that don't want to deal with them because they have huge portfolios, and it makes perfect sense. It's not their business, and it's your business. So what is your business plan from taking on? Are you going to get these people back on track? And how are you exiting the notes?
Yeah. So typically, our primary goal is to try and get the borrowers reperforming and get them back on track. Our goal isn't to go in, foreclose, and take the property back. We try and work with the borrowers when they want to play ball. There's only so much you can do if a borrower is not responsive. It's got to work both ways. But typically, we like to keep borrowers in their properties. I mean, we have a whole podcast talking about doing the good deeds of keeping people in their property. But it's, for us, that's what, part of how we operate, but also just be flat out honest with most people. If you can get them reperforming and get them on new payment stream, and whether it's lowering the payment or pushing some of the late charges and past due interest to the end of the loan, it tends to be more profitable at the end of the day. So it's a win-win for both people where they get to stay in their property, which today's world probably has equity in it. You work the agreements with them. And then if you can get that on a consecutive payment stream for 12 plus months, you can turn around and sell that loan to somebody as another investor, maybe in a performing fashion, where you might be selling it to them at 75 to 80 cents on the dollar. So you can kind of see some of the math numbers there.
So the industry is like a 12-month seasoning process. That was my next question.
Typically, it's interesting. I go by 12 months. The standard is 12 months, but people try and change those standards. Some people will be like, well, it was paying before COVID, so it's still performing. And it's like, well, the money's not coming in the door, so it's not performing. Some people will think it's a month or 3 months. But for us, typically, we like to go off of 12 months because that shows some consistency.
Interesting. Okay. And then you're putting this back out onto another market to sell it after this process, after this 12 months, like we just talked about. Is that correct?
Yeah, we've found a very nice niche that we're in where, we typically will buy 30 to 60 assets at a time. So that's considered somewhat bulk, not really, but we get a discount for buying that much at a time, where we'll buy from some of those larger hedge funds. And then we'll buy those. And once we get them worked out, there's a lot of investors out there who like to buy ones, we call them onesie twosies, one-offs here and there, especially people who have self-directed IRAs because of the way, your deferred taxes, and with notes, there is really no tax benefit because it's actually ordinary income. If you're using your own cash, it's actually probably a disadvantage. But on conventional real estate, you get the depreciation tax benefits, which if it's in your IRA, you don't get that. So you might as well use your IRA for items that don't provide any tax benefit and use your other cash for real estate, which is what I do and what a lot of people do. So we find a lot of selling those assets off to investors who like to buy one or two here and there.
Okay, interesting. So, what is for the people that that these mortgages for the properties that they're in? I mean, you're getting these high returns. What are they paying for these mortgages, and why are they having a note that's being sold off? Obviously, if it's not performing, but what are the rates that they're usually paying on this? Is it lower? Did they go through is it just a normal person that went through a normal conventional mortgage and then or is it seller financing that's now being sold off, or?
It's a mix. Most of the loans we see are between 5 and 9%.
Oh, wow.
So they're higher than what most of us think of, okay, you get 3%, 3.5%. A lot of these were originated back, 2010, 12, 13, when rates are a little higher, but also a lot of them are borrowers who have had questionable credit. So they may have gone a non-QM route or some other means to get the loan. So we typically see a little higher interest rate, which is, includes when you discount it as well and get them paying again, it again increases those returns, which you mentioned returns. And, we target for every non-performing loan to get around a 30% return on those is what our target is. If it's a performing loan we're looking to buy, you can buy those between 10 and 12%, 8 to 12%, depending on, the situation and the state, of course, because some states are much riskier because if a default, there's a lot more legal expenses and foreclosure timeframes. But, that's our target. I'd say overall in our portfolio, our historical returns average somewhere in the mid 20s. Now, I just going to make stipulation that, past performance is not an indicator of future performance. That's kind of where we've been at, though.
Okay. Yeah. The SEC disclaimer, everybody has that.
Yeah.
Before we get into your funds, because I'm very interested in learning about them as well. And what is the process? So you take a non-performing loan. I imagine you have a whole team for this what is the process for you? I imagine you try to make contact with them, and then where does it go from there over, and how many months does it normally take to get them performing again? And if you're able to, and how does that whole process work, what you're doing on your side after you've acquired the note?
Yeah. So I'll even go a little bit rewind because it's very different. And I'll talk about even buying a note, because when you actually bid on a note, you're typically bidding on the asset blind and you're not spending money. You'll get a list of assets called the tape, and you'll bid based off the information that's on that tape. And I'll do some research online and maybe look at like Google Street View and, spend probably 20, 30 minutes bidding on an asset. And then if it gets under agreement, that's when you'll receive all the collateral, which is all the loan files from that current lender. And then I'll order a title report to check on title and if there's taxes owed, because most people aren't paying a mortgage, not paying their taxes. And then we send somebody by the property to take photos of it, which you don't get to see the inside of the property. You're a lender, your lender comes knocking on your door. You don't just let them in, especially if you weren't paying.
Yeah.
So it's kind of done on a handshake deal. And that's what I wanted to mention, because it's kind of a back and forth via email and stuff of, hey, we're agreed. Then you finalize, negotiate the price. Then you sign the loan sale agreement, you wire the money, and boom, you bought a note. So the process, though, is you rush through that process, which takes about 2 to 3 weeks. And then you have to sit and wait. And the reason why is you have to hire a licensed servicer. And that's the company that actually collects all the payments, does all the reach out, calls the borrower for you. And once you buy the loan, it takes about a month for the servicing companies, if you're using a different one, to transfer all that data, from all the past history, make sure it's in their system properly, because the last thing you want is it to be put in improperly. And so that's about a month. And then once they get that squared away, they send a letter saying, hey, you have a new lender. Here's where you send your payments. And oh, by the way, if you disagree that you owe this money, you have 30 days to dispute it. So you're basically just now waiting another 30 days for that process to happen. Now, typically, so that's 60 days after you've bought the loan. So after that, then if there's been, they can still call and, reach out to them and so forth to, ask them, if they want to start making payments and so forth. But then typically at that point in time, if there's been no communication, that's when we'll get an attorney involved, and we'll have attorneys send what's called the demand letter, which is a letter demanding payment. And that typically is what starts to get people to wake them up. Some people just see a letter, they throw it in trash. Oh, it's somebody else, whatever. Once you see something from, law office of ABC, typically that's when they'll start to wake up and you'll try and work something out with them. And if that doesn't happen, 30 days go by, or 45, depending on the state. And then that's where you can file a legal complaint, which is, you file that, with the courts, if it's a judicial state, but you file, basically to start the foreclosure action. And in many instances, they get served either by a sheriff or by, somebody to hand them the documents that they have to sign for. If they didn't jump at the first instance, now they're typically is when you get them back in play, because now they're like, oh, this person's serious. So, but then you'll still, I mean, go back and forth for another month or two. So on average, it'll probably take about 6 months to, get something worked out
Wow.
with a borrower.
Interesting. And what kind of percentage? I'm not sure if you mentioned it earlier. You said uh, that you usually are able to have them perform again.
Yeah, if it's a owner occupied single family residence that, like I said, it's occupied, it's above 50%. I'd say
Oh,
it's
nice.
close to about 75%. Now there's, when we're buying 30 or 40 at a time, there's some that might be vacant, or, I'm taking away the ones that the borrower is deceased and things like that, because, those, what the outcome is going to be. But it's around 75% of, the loans where somebody's owner occupied in the property, we work something out. And those other 25, honestly, it's in many instances, they just never respond to anything, and we've got almost no choice or no option.
Interesting. So, what kind of states do you like working in and buying notes in that make it easier for a note investor?
So it's interesting because, like, some people love Ohio, and I joke, I said Ohio stands for only headaches in Ohio, is the acronym. uh the Southeast typically is areas, we like Tennessee, Missouri, uh, the Carolinas, Georgia. Uh, I like investing in those states because, one, home prices continue to appreciate. People are moving to those areas, as well as their foreclosure laws are not, extremely burdensome. You get up into the Northeast, which is
Mm.
where I'm from originally. New York, you're looking at years to foreclose. Georgia, it's like 45 days. So it's such an interesting difference from that perspective. But typically, I've invested in 35 states, but the majority of them are in the Rust Belt and down
Yeah.
into that Southeast.
Yeah. So, Midwest, Mid South, Southeast, landlord
Yep.
friendly states, I guess you would say.
Yeah, pretty much.
From what we're saying. Yeah. I'm from Connecticut. So, I know how it works up there. I still have rental property for years up there. So, I know all the headaches and everything that goes with that wonderful place. So, talk about those different funds. You have a couple open-ended note funds to
Mhm.
accredited investors. Obviously, that's why we're talking returns here, because you can do so. And
Yep.
then you have partial notes too. So if you don't mind
Mhm.
kind of explaining what they are and
Mhm.
how they work.
Yeah. So the two funds we have, one is a performing note fund, which we just buy performing notes, and we offer investors preferred returns between 8 and 12% preferred return based on the investment that they put in. There's no management fee in those funds or anything. It's a straight, our income is made off of, the difference between what we buy the note from and what the preferred return is. So from that, investors get a interest payment every month based on which pref they're in. So it's nice that, just get that monthly check, or you can reinvest it. And it's only a 1 year, 1 year hold time on that for an investor. So, it's something, if you want to put cash away for a year to see what's going on with the markets and so forth, it's a nice little niche from one aspect. The other fund we have, called the Integrity Mortgage Note Fund, that one's a 3 year hold, where that one's going to be primarily more non performing loans. And that one, the preferred returns start at 7%, but we're also offering 25% upside to the investors. Now, I know people who invest in multifamily look at them and they're like, oh, well, typically it's the other way around, where the sponsor gives away most of the preferred return. And I'll be honest, we don't try and compete with the multifamily because a lot of those are 5 to 7 year hold times. But also with the fees that, once you get property management fees and all these other fees involved, you pay a lot in fees that end up diminishing that bottom line a little bit. That goes back sometimes to sponsor or their affiliate companies. So you can't really judge them because even though it's real estate, it's two different market sectors.
Yeah.
So, in that fund, we target investors, we're looking to get them 11 to 15% returns
Wow.
per year is what we look to get investors on that. And then partials, this one's interesting because this one typically confuses people a little bit. And what a partial is, say I have a loan that has 100 payments left on it. I can basically bifurcate it or hypothecate it where, Charles, I'll sell you 50 payments. So basically, but you're secured by that collateral. So it's basically taking that first position loan and putting you in position 1A and I'm in position 1B. So and I manage it and basically send you the next 50 payments. And there's an amortization table based off of 9% that you'll get, a principal and interest payment based off of 9% based on what you invested over a period of time, which is typically 4 to 7 years, that gets paid back to you. So it's almost like, the borrower is essentially paying you. And on those, I take on all the risk. If it goes delinquent, meaning that I have to go out of pocket my costs, that investor's not out of pocket any cost. I've done over 60 of these, and it only once has a borrower failed, stopped performing, which we ended up foreclosing, and the investor actually just got their money back and got paid from that perspective. So they, got their returns as they had promised. So it's, what I would consider probably, the lowest risk because you're getting your principal and interest back. But it's over a 4 to 6 year period that, the performing note fund also, in, my perspective, is less riskier. Of course, there's always risk in any investment than, the non-performing fund. Of course, higher returns does have a little higher risk, but those two are my fourth and fifth fund. We've got one of them. My first fund is wrapping up in the next few months, which has done very well. And the other two funds we've operated, again, have performed very similar. And we expect to hit the returns to the investors that we've stated, and which I've stated early, which is that 11 to 15% to those investors.
Interesting. And this is paid, you said one was a monthly, is another one paid quarterly?
Quarterly, yep.
Okay.
And, it's similar to most funds. If, there's a quarter, like the first quarter is sometimes questionable because of that period I said of buying and getting things locked up. If you miss that first quarter, basically you're still owed it. It's not as if it just goes away from that perspective. So, and then the excess, at the end of the year, the CPA does the books and says, hey, there was this much extra profit that will in that integrity fund that gets, distributed to the, gets split up to the investors as well.
So on the real estate investing side of it, not the debt side, let's say on the equity side, what we really kind of focus on, it's obviously very competitive. How is it with note investing? Is it very competitive as well right now? And how has COVID changed your business?
So it's not as competitive as other real estate industries by any means. There's a lot less people involved in this because there's a lot of work, and a lot of people don't want to deal sometimes with the hassle of lawyers and a borrower getting an attorney. You kind of have to have a certain personality to deal with that. Thankfully, I do, based on my background. So, I mean, it's competitive, of course, but not nearly as competitive as, trying to do fix and flips or buy and holds at this point in time by any means. In COVID, it's been interesting. I've had on my performing loans less than a 5% default rate on COVID from COVID related. And in the same token, I've also had more borrowers last year who refinanced and paid off the loans. So actually it was it was actually a better year for us because yes, we did have some people go delinquent, but we also had others come through. The other thing that's been beneficial is, for example, in the state of Pennsylvania, the Pennsylvania Housing Finance Association is a nonprofit that gets state money, and they assist people who have missed their payments to get them caught up. So people who have missed payments, even if it was before COVID, they've stepped in and helped these borrowers to get them caught up. So we've been able to, benefit from those as well. And it again goes to show when you try and work with people, because sometimes, with those agreements, you may have to lower the payment or even lower the interest rate, which at the end of the day, you drop an interest rate, by, 2 points, yes, does it impact the bottom line? Yes, but not that great of a bottom line. And it's not that impactful. And it's actually, when you look at it, you're getting that person to continue to pay, which you don't know if they could on that prior rate. So it's just a win-win, all the way around.
Yeah, it's the same thing with real estate with apartments. And during COVID, we weren't raising rents on renewals, and it's better
Mhm.
to have someone in there paying versus
Mhm.
someone of versus a vacant unit, and that's 2 months done, and the whole story that goes along with that. So interesting, very interesting. I know I've spoken to other note investors individually, and I imagine you do as well. Like, what mistakes do you commonly see other real estate note investors make?
The three, the three biggest risks in note investing are taxes, title, and property condition. And I see time and again people trying to take shortcuts or not spend the money to
Mhm.
order the title report or check on the taxes or send somebody out to the property. Those are the three biggest things that I see. And the other is people getting into it too early. People will go take a weekend seminar,
Mhm.
which just like in any aspect, real estate, stocks, they have these weekend courses you can go take that give you an overview, and they make it sound like it's really good, really easy, and really profitable. And they say follow these 5 steps, and you start on Monday. You follow these 5 steps, and these people start bidding on assets. And the reality of it is they have no idea what they're doing.
Yeah.
And I've seen, time and again. The one other thing I'll mention is, and this goes for all aspects of real estate, is if you're going to partner with somebody, whether you're the sponsor or you're the equity partner, whatever it is, you know, don't just take somebody's word for it. If Charles says, "Hey, Chris is a great guy," because I was on a podcast, make sure that you do a background check on that person and check their references, and then ask that person, "Well, you're referring him. Have you actually worked with him?" "Oh, no, but I've had a beer with him and he's a good guy." Well, that's not good enough.
Yeah.
I've seen far too many people in this business follow somebody's recommendation like that and then get burned. And unfortunately, there's a person I recommended to a few people, and then found out, later on, this person ended up having a lot of issues, and then basically now those people got burned in the note space, and it's a very small space. So, and people in the note space probably know who it is,
Mhm.
but it's unfortunate because it's something that you just want to make sure that you do a proper check on somebody in from that perspective.
Yeah, I think I know who you're talking about. The so the thing with let's talk about title issues before we wrap up here, because it's very interesting. Obviously, title issues would be additional liens on the property that you probably haven't noticed. But is there anything else? Are any of these are all first position?
Yep.
Is there any second position that you ever find, or what are the big problems? Or obviously, a red flag would be anything that comes up that isn't clean, other than that lien. But what are normal things you find issues with titles,
Taxes. The
taxes?
other is if a family member who was on the loan deceased and it didn't go through probate, or
Mm.
then they just are like, "Oh, we'll just quit claim deed," and somebody's elderly, they just quit claim deed to another family member and they pass away. But the quit claim deed's really worthless,
Yeah.
in many instances from that perspective. I've got one right now that uh, we're looking at where there's just so many title issues because they kept transferring this thing back
Um,
and forth. The other is sometimes title companies make a mistake where I've had some where they had to record multiple documents at once. They record them out of order from certain perspectives. So that's some others. But yeah, typically liens is what you will see, the liens and the taxes. And also what you got to check is in certain states there's a county tax. There's like Pennsylvania. There's a county tax, a school tax, a local tax. There's
mm,
all these other taxes. And if you are using a title company or just trying to check them on your own, because some people do that, and you just make the phone call, you're not checking the other one. Well, if the school tax is $3,000, but the local tax is only $500, and it's like, oh, it's only $500 or $1,000 past due. They missed 2 years, and you missed the other 6,000 in
yeah.
taxes. And what is people, again, sometimes people just go cheap and they tell the title company,
Mhm.
"Oh, don't check the taxes, I'll check it myself." And it's an extra $30, and $30 on a $30,000 investment really is,
Yeah.
unwise and not spend that money.
Interesting. Interesting. Yeah, that's a lot of great information. So, what do you think are the main factors that have contributed to your success?
Ooh, uh, I, you know, For me, it's inconsistent. Consistency of, people, start with something and they hit a little bump in the road and they stop. One of the things that I'm horrible at is trying to stay in shape, where, my gym is literally right over there. I've got it and it's like, oh, I'll go 2 days a week, then something will happen. I'll miss 2 days. Then I'll miss 2 weeks. And it's, trying to, get back in the swing of things. So that's one thing I mentioned to people is consistency. And the other thing is, in a business, you do have to spend money to make money.
Mm-hmm.
And there's certain things that you really, from to reducing your risk, for example, working with a good title company, working with good attorneys, you're going to pay a little bit more, but you're also reducing your risk. And then you build those relationships, and larger companies typically use the better attorneys. And all of a sudden, when I'm using the same attorney and somehow I get introduced to another company or somebody else, all of a sudden it's, hey, I can start buying from this person or something along those lines. So networking, when you're using good vendors, can lead to much better and bigger relationships.
Yeah, no, that's one thing when I talk to new investors, mainly in like the real estate equity portion of it, and they don't want to invest a little bit of money in getting stuff set up correctly. And, there's all this potential to make money, but a lot of people don't want to spend money, and they're, spending money here, but not where it really counts. So
yeah,
it's interesting, but okay, perfect. So how can our listeners learn more about you and your business?
Yep. So they can go to my website, which is 7E Investments, but it's a number 7, the letter E, then the word investments.com. Is the best way. On there, you can contact and reach out to me and learn more about the investment opportunities we have. If you're interested in more notes, we have the Good Deeds Note Investing podcast that we launch a show weekly. And, I enjoy it because that's where I tell the stories that we go through with borrowers and lessons learned. And sometimes it's a vent fest where, I'm just, upset and just venting about something that's happened. But it's really telling the true life story of it, because again, it goes away from the weekend warrior courses where everything makes things simple to try and tell that story. And then another place to learn is if you're on Facebook, we have a group called Notes, not Nuts, Notes and Bolts from the Good Deeds Note Investing podcast. So those are the 3 places I typically, can be found pretty easily.
Awesome. Well, thank you so much for coming on and letting our listeners learn about another route of making money through real estate. And I'll put all those links into our show notes. So thank you so much.
Thank you, Charles, for having me.
Talk to you soon.
Yeah.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.